Greetings, everyone. This video is Chapter 4, Part 2. So let me go ahead and share my screen. Okay. Here we go. Perfect. I'd like to begin about talking to you about freight cost. Who is going to pay the freight costs when you ship your inventory to your business? Is the seller going to pay the freight, or are you, as the buyer, going to pay? Well, it all depends on what you arranged with the seller. So on the invoice, you might see these terms: FOB shipping point or FOB destination. FOB stands for free on board. So if it's free on board shipping point, well, the shipping point is where the seller is. So it's going to be free on board to the seller. So the buyer pays. If it's free on board destination, well, we are at the destination. We're the buyer. So it's free on board to us. So that means the seller is going to have to pay. Now, it's interesting that from a buyer's point of view, when we buy that merchandise inventory, we're going to be debiting a merchandise inventory for the cost. But also when we pay for the freight, we're going to be debiting merchandise inventory. Why? Because we're going to include all the cost of not only purchasing the merchandise, but getting it to our place of business. So from the buyer's point of view, when we pay a freight charge, we're going to debit merchandise inventory. Now, if you're the seller, it's an operating expense. So that's going to be like freight out expense or delivery expense. So I'll talk a little bit more about that just a second. Let me go ahead and stop the share here. And let's see if I do this. There we go. I have this little graph here. Let's say that we are here in Fresno. We're the buyer, and we're buying something from Los Angeles. Well, Los Angeles is shipping point, and we are in Fresno, and that's the destination. Well, who assumes the freight charge if it's FOB shipping point? If it's FOB shipping point, it's free on board at the shipping point. That means it's free to the seller in Los Angeles. So we, the buyer, is going to have to pay it, right? So FOB shipping point, the buyer is going to pay. You know, when I was a student, I remembered it by like this. My instructor didn't really explain it very well. So I just remembered it like FOB shipping point, the purchaser pays, with all the P's, right? So that might help you too. How about if it's FOB destination? Well, it's free on board at the destination. Well, who's at the destination? We are at the destination, right? So it's free on board to us. That means the seller in Los Angeles is going to have to pay. Okay. We'll go ahead and let's see if I can get here. Okay. So I kind of like this graph again. This is I'm gonna say it a different way, maybe to help you out a little bit. But we have a seller at the shipping point, and we have the buyer at the destination. So if it's free on board at the shipping point, right? The seller is at the shipping point. So that means the purchaser is going to pay, right? The buyer is going to pay, right? It's free on board at the shipping point where the seller is. Now, so if the buyer pays, then the buyer is going to debit merchandise inventory, because to the buyer, that freight charge is just another cost of that merchandise, right? It's so to the buyer, it's not only the cost of the merchandise, to buy the actual product, but also the freight charge to get it to the place of business. So anyway, debit merchandise inventory. Now, if it's FOB destination, well, who's at the destination? The buyer is. So it's going to be free on board to the buyer. That means the seller is going to have to pay. Now, when from the seller's point of view, it's an operating expense. So here, the seller is going to debit delivery expense. So you just got to remember that if you're a buyer, you're going to include the freight charge as merchandise inventory. If you are a seller, you're going to include that freight charge as delivery expense. Okay, let's go ahead and try an example here. Z-Mart purchased merchandise on terms of FOB shipping point. Well, that means FOB shipping point, the purchaser pays, right? Remember, the shipping point is where the seller is. It's free on board to the seller. So we are going to have to pay it. Z-Mart's going to have to pay it. So the transportation charge is $75. And remember, because we're the buyer, that is going to be an inventoriable charge to us. We're not going to go delivery expense, right? It's not. To us, it's merchandise inventory. It increases our cost of the merchandise. So in this case, debit merchandise inventory, 75. Credit cash, 75. Yeah, because the freight charges were FOB shipping point, Z-Mart is responsible for the freight charges, and we increase the merchandise inventory account for the cost of the freight. Okay, I decided to kind of not do this one just to save some time. It's not that critical, so I'm going to move on here to this. This is an itemized cost of merchandise purchased. This is what makes up the cost of our inventory. So, like I was saying, that yeah, the when you purchase inventory, the cost of the product is included, right? The price of the product is fine, but it's going to be reduced if we receive any early payment discounts. The deal is, hey, if you pay me within 10 days, you can take 2% off. Well, if you pay them within 2 days, you pay your vendor within 2 days, then that merchandise didn't cost you as much as you thought. So you're going to reduce the cost of the merchandise. And that's why we less purchase discounts. And how about the purchase returns? Well, that totally makes sense, because if you returned it, you don't have that inventory. So you have to reduce the cost of the inventory, right? So that would be a reduction. Purchase returns and allowances would reduce the cost of the inventory. And like I was saying, that any transportation cost to get your merchandise from the seller to your business, that's an inventoriable cost. So we're going to add that transportation cost to the cost of our merchandise. Let's try some journal entries here. We've got, on October 1, we purchased 125 units of product at a cost of 4 units. Well, what would that be? Well, let's go ahead and see. 125 units times 4. Well, that's going to be 125 times 4 is 500. So we're buying $500 worth of merchandise. Now, we know the terms are 210 net 30. And you know what? When you see terms, you know it's going to be accounts receivable or accounts payable. In this case, because we're purchasing it, it's accounts payable. Okay. Now, right now, let's say, well, the terms are 210 net 30. So let's say that we wanted to take advantage of that 2% off for early payment. When would we have to pay it by? Well, we bought it on the 1st. 10 days from now would be October 11th. So if we pay for this inventory, by October 11th, we can take the 2% off. If not, the whole thing is due in 30 days. Spoiler alert, we are going to pay within the discount period here, October 11th. So just keep that in mind. We're going to get 2% off of this. All right. Now, this says FOB shipping point. If it's FOB shipping point, the purchaser pays, right? So, yeah, that means that we're the buyer. We're going to have to pay the freight. Now, when we pay the freight, we're going to be debiting merchandise inventory, right? When we're the buyer, we debit merchandise inventory. If we're the seller, then that freight cost is going to be delivery expense. But in this example, we are the buyer, so we're going to debit merchandise inventory. October 3rd, paid $30 cash for freight charges from UPS for the October 1 purchase. Okay, that's good. Well, then what are we going to do? We're going to panic. No, we're not. We're not going to panic. We're going to record the freight charge. And remember, because we're the buyer, that freight charge is just adds to the cost of our inventory. Debit merchandise inventory 30, credit cash 30. All right. On October 7, return 50 defective units from the October 1 purchase and received a full credit. Well, those 50 units cost us $4 a unit, right? So we're returning it, right? So how much are we returning? Well, 50 units at 4. So we're giving it back. So we have to reduce our asset merchandise inventory. Now, because we gave it back, we don't owe them anymore, right? So we have to debit our accounts payable to reduce our payable. So on October 7, debit accounts payable, credit merchandise inventory. Now on this one, we paid the amount due from October 1 purchase less the return on October 7th. Well, how much is the amount due from the October 1 purchase? Well, we kept track of it here. On October 1, we bought $500 worth of merchandise, right? There's our debit for $500 on the inventory, and here's our credit for $500. But then on the 7th, we returned $200 worth. And if we did that, we don't owe that $200 anymore. So right now, we owe $300, right? So when we're going to pay it, we are going to be forgiven for the full $300. So debit accounts payable $300. But do we have to pay cash of $300? No, because we paid within the discount period, October 11th. Remember, I said that if we paid by October 11th, you can take 2%, right? October 1 plus 10 days is October 11th. So if October 11th, we can take our 2%, which we're going to do. So we're going to take a 2% discount. Now that's interesting. We're crediting merchandise inventory by the discount, right? $300 that we owe times the 2% discount. We're crediting merchandise inventory by 6. Why? Because the merchandise isn't costing us as much as we thought. We thought it was going to be $300, right? Matter of fact, but no, we're getting a 2% off of that. So there it is. We reduce our merchandise inventory by the discount of 6. And now we can plug and chug how much cash. 300 minus 6 is 294. Now, for some of you that want to double check your work, you can use the complement method to make sure everything's right. You know that we owe $300. But we have a 2% discount. So we only have to pay 98% of that 300. So if I go 300 times 98%, that would give us 294. So you can do it two ways. The old plug and chug, the 300 minus 6. That means you plug the 294, and then you can double check it by doing the complement. 300 times 98% is also 294. You just now notice that our inventory is now holding at 324, and looks like, man, we paid off everything, right? We owed 500, but then we returned 200, and then we paid the balance, so we don't owe anything anymore here. Okay. Now, what would happen if we didn't pay on October 11th? We missed it. So if we do that, we missed it. Well, the whole thing is due, right, in 30 days. So what is 30 days from October 1? Well, it's October 31. So we're not late, but because we're paying within the credit period, but because we're not paying within the discount period, we've got to pay the full amount. So there we go. We missed the discount period. So we owe 300 and we have to pay 300. Okay. Quick question for you. In a perpetual inventory system, a return of defective merchandise by a purchaser is recorded by crediting what? Well, in a perpetual system, it all revolves around inventory, inventory coming in and inventory going out, and the reductions in cost of the inventory and all those type of things. So it's D, inventory. When you return your merchandise, you don't have it anymore, right? So you have to reduce your asset inventory. Let's now move on to the sales side. We've been focusing at this point on purchasing. Let's do sales. This is interesting. I want you to write this down. This kind of freaked me out when I was a student, and I just kind of got over it because it does make sense. When you record a sale or make a sale of merchandise, there's really two parts of an entry, two entries created here. One for the sale and one for the fact that you had to sacrifice your inventory and it becomes cost of goods sold. So let me give you an example of this as you're writing this down. Let's say you're in a grocery store and it's your store, and your customer buys a can of S&W green beans. So you take the green beans and you scan it. Shoot. Behind the scenes, the computer is going to be crediting sales to make the sale of those green beans. And in this case, because it's a supermarket, you're going to record cash. But to make the sale, we had to sacrifice our inventory. So we also have to show that our inventory of green beans went out. And when you sacrifice the asset inventory, it becomes cost of goods sold expense. And it happens that fast. Anytime, like producers milk, debit cash, credit sales, debit cost of goods sold, credit inventory. That's why the computer is so good at this type of thing. And in my day, we didn't have scanners when I was a young man. And so we couldn't use the perpetual inventory. We didn't have the technology, but we are now in the future and we do have the technology. And that's why we can teach you the perpetual method. Let's blow that slide off and go right to this. Let's record a sale of merchandise. Here we go. Zmart sold 2,400 of merchandise on credit. So, it's going to be accounts receivable, right? The merchandise has a cost basis to Zmart of 1,600. Okay, so how are we going to do this? We're going to do it very carefully. The old joke, yeah. Okay, well, we're going to have actually two entries here, right? The first one is to record the sale, the core of the revenue. So we're going to record that we sold merchandise, made the sale of $2,400, and now our customer owes us $2,400. Debit, accounts receivable, $2,400. Credit, sales, $2,400. But to make that sale, we had to give up our inventory, right? So we have to credit our inventory. Remember, an inventory is an asset. When we sacrifice an asset, it becomes an expense. In this case, cost of goods sold expense. So debit, cost of goods sold, $1,600. Credit, merchandise inventory, $1,600. So this is what it cost us, right? $1,600. And this is what we sold it for, $2,400. Can anybody see what the gross profit was on this? Well, sales of $2,400 minus cost of goods sold of $16. That would be $800 gross profit on this particular sale. That's just a little information for you. So just remember, there's two entries to record a sale of merchandise inventory. Let's talk about the computation of gross profit and how we arrive at the bottom. And we're going to be focusing a little bit more on the net sales part, but this is how it all kind of works. If you can get used to this, you're doing pretty good. You start out with sales, right? And that's $321,000. That's good. But then if we give our customer a discount for early payment, well, we didn't really make the sale. So we are going to debit an account called sales discounts. Now, sales discounts is a contra sales account. It goes against the sale because we didn't make the sale because we gave them a discount. Now, we could just bury that discount as a debit to sales, but you business management majors, you're going to want to see that. Well, how many discounts are we giving our customers? Likewise, if our customer returns the merchandise, we didn't make the sale, right? So we have to reduce the sales by debiting the sales returns and allowance account. It goes against the sales, right? Sales is a credit, and then the sales returns and allowances would be a debit. These are debits. They go against the sale. And that makes sense, right? If our customer returned it, we didn't make the sale. So we have to back it out. Now, again, we could just debit sales directly and not have this figure here for sales returns. But you business management majors, you guys are going to want to see how the dollar amount of your returns. If it gets really high, you're going to have to ask yourself, well, why are our customers returning our merchandise? Don't they like the merchandise? Is it defective? Anyway, as managers, you're going to have to find out what's going on here. And the accountants give you this information so you can make those decisions, right? Okay, so now you've got sales less the contra accounts, sales discounts, and sales returns and allowances, which together equals 6,300. Now we have our net sales of 314,700. Next, to get to gross profit, we take net sales minus cost of goods sold to get our gross profit. Okay, so that's kind of the overall picture here. Okay, let's take a look at sales discount again. Remember, a sales discount is for prompt payment. It promotes prompt payment. 210 net 30. If you pay me within 10 days, I'll give you 2% off. And they're going to go for it because that's a pretty hefty discount. You know, you get 2% off, just pay within 10 days. Everybody's going to do it. So what you're going to do then is when you offer that discount, then you're going to have to reduce your sales, but you don't, because you didn't make the sale, right? You gave them a discount, but you don't credit sales directly. You debit the contra sales discount account, right? with a debit here. So that contributes to net sales, right? The sales discounts is a contra revenue account. It's a contra sales account. Now, when can you, when can the customer take advantage of that discount? Well, the customer has to pay within the discount period. If the terms are 210 net 30, then the discount period would be 10 days. If they pay within 10 days of the invoice, they can take 2% off the invoice, right? Now, if they don't and they miss it and they have to pay after the 10 days, well, the whole thing will be due in the credit period. In 210 net 30, that's the net 30 part. The credit period would be 30 days. And if they pay at the end of the credit period, well, they don't get a discount. They got to pay the full invoice price. Okay, let's go ahead and do a sales discount. Zmart completes a $1,000 credit sale with terms 210 net 60. So yeah, you have to pay within 10 days to get 2% off. If not, the whole thing is due in 60 days. Well, that's pretty good for the customer, not as much for us. I don't want my money faster, but whatever. Okay. Anyway, so we make the sale and our customer owes us money. So debit accounts receivable, 1,000, credit sales, 1,000. Now, what happens? No, check this out. This is November 12th. So let's figure this out. What is the discount period? What's the period of time that our customer can take the 2%? Well, they have to pay within 10 days. Well, what's 10 days from November 12th? 12 plus 10 is 22. So they're going to have to pay us by November 22nd to get the 2%. Well, let's say in the first option that they don't. They decide, I just don't want to do it. I'm going to pay at the end of the 60 days. Okay. Well, trust me on this. The 60 days from November 12th is January 11th. So they're not late. They're paying within the credit period, but they don't get any discount. So you're going to forgive them for a full $1,000, but they're going to have to pay you the full $1,000 in cash. Debit cash, 1,000. Credit accounts receivable, 1,000. Now, how about option 2? When the account was paid within the 10-day period. So we said the 10-day period was November 22nd. Again, it's 210. So what's 10 days from November 12th? 12 plus 10 is 22. So they're good. They can take the discount. So the deal is we are going to forgive them for the full amount of $1,000. But because they paid within a discount period, they only have to pay 98% of it, which is this cash of $980. And the discount would be the $20, right? It's 2% of the 1,000. 1,000 times 2% would be 20. And you can also double check this too. You know that well, if you're getting a 2% discount, you're paying 98%, right? So what's 98% of 1,000? Well, 980. So there's different ways you can do it. Probably this is one way. You would say, okay, accounts receivable, credit 1,000, figure out the discount. Well, what's 2%? And that's 20, and it's a contra revenue account. You want to put it on the debit side, and then you simply plug and chug. 1,000 minus 20 is 980. And then you can use a complement method if you want to figure out if you did it right. Well, if you get 2% off, you know you're paying 98% of the $1,000. So $1,000 times 98% would be the 980. Okay, let's go ahead and talk about sales returns and allowances. And again, sales return and allowances is a contra revenue account, or I like to think of it as a contra sales account, and it's a debit. Well, that so makes sense, right? Because if sales, which is a revenue account, is a credit, the contra account would be a debit. And remember, if a customer returns an item, well, you didn't make the sale, did you? So instead of debiting the sales directly, you debit the contra sales account, sales returns and allowances, right? Now, the reason is that you want to keep that information available to the business managers who are going to look at it and make a decision. Well, man, what's going on here? If it gets too big, they're going to have to investigate and make policy changes, right? So as a reminder, a sales return is one where the customer returns the merchandise. They physically return the merchandise. Now, an allowance, the customer keeps the merchandise, but then you just give them off a little bit off the price. And why would you do that? Well, let's say that the items are slightly damaged. Okay, so but they're usable. So instead of taking them back, the customer said, "Okay, well, if you give me a little bit of a price reduction, I'll keep them." Okay, so you will. That's an allowance. In the sales return, the customer keeps the merchandise. I mean, I'm sorry. In a return, the customer gives you back the merchandise. In the sales allowance, the customer keeps the merchandise. There you go. Okay, looks like we're going to return items that sell for 800 and a cost of 600. So if you recall correctly, that we had a sale of 2,400 and that the merchandise cost of 1,600, but now the customer returns part of it and the items returned sold for 800 and it costs us 600. Well, how do we do that? It has to be two entries. When a customer returns the merchandise to you, you didn't make the sale, so you have to reduce the sales through the contra sales account, sales returns allowances, and also you have to receive the inventory, right? Because he gave the inventory back, and if he gave the inventory back, it wasn't sold, so you have to reduce the cost of goods sold. So again, I'll go from the top here. He returned $800 worth of merchandise that we sold him. Well, if he returned it, he doesn't owe us that anymore, right? He returned it and we didn't make the sale. So it's debit, sales returns and allowances, credit, accounts receivable. Okay. And then he did give us the inventory, so we got to record the inventory asset coming back in. And if the inventory comes back in, it wasn't sold, so we have to reduce our cost of goods sold. So debit, merchandise inventory, 600, credit, cost of goods sold, 600. Okay. Now that's for a return. Now for an allowance, remember that the customer keeps the merchandise. So in allowance, you'll only do this entry. You won't do the second entry, right? Allowance, they keep the merchandise, so you don't get it back. So in allowance, you have one entry. Let's see what it looks like. Assume that 800 of the merchandise Z-Mart sold on November 3rd is defective, but the buyer decides to keep it because Z-Mart offers a $100 price reduction. Okay. So one entry required. We're gonna give him off the price, so he doesn't owe us $100. And if because it's allowance, we didn't make that part of the sale. So instead of debiting sales directly, we debit the sales returns allowances contra account. Again, one entry, debit, sales returns allowances, credit, accounts receivable. And remember, sales returns and allowances is a contra revenue account. That's why it's a debit, right? Sales is a credit. And so the contra sales account would be a debit. Let's go ahead and look at exercise 4-6 on page 186. I'm going to do this with a PowerPoint. It's nice. So just kind of enjoy the show. You make notes if you like. And also remember, you've got this PowerPoint presentation in Canvas. Okay. We are Allied merchandisers, and we were organized on May 1. Macy's company is a major customer. They buy from us. And so that Macy is the buyer, we, Allied, is the seller. And we're going to prepare these journal entries for Allied. Remember, we are Allied. And always, we're going to be using the perpetual inventory system and the gross method. Okay, so on May 3rd, matter of fact, I'm going to do this. We can just kind of see it. On May 3rd, Allied made its first and only purchase of inventory for the period for 2,000 units at $10. Well, 2,000 units at $10 cash, right, cost $20,000. So we bought inventory of 20,000 and we paid cash for it. Easy enough. I like that. On May 5th, Allied sold 1,500 of the units in inventory for $14 per unit. Okay, well, 1,500 units and you sold it for $14. You sold $21,000 worth of merchandise to Macy. And the terms are 210 net 60. Okay. You know what? Maybe I should, before I get into that, let's go ahead and record the sale. Okay, so it's 210 net 60. So you know it's going to be on credit. So we're going to be debiting accounts receivable. And how much? Well, we sold 1,500 units at $14, right? So he owes us 2,100. And why does he owe us? Well, we sold it to him. So our sales is 2,100. Okay. Now, how do we make that sale? We had to give up our inventory. We sacrificed that inventory. And well, how much did 1,500 units cost us? Well, they said it was here in May 3rd, it was, we bought them for $10 each, right? So we are going to have to record 1,500 units at $10 going out of our inventory account. That's an asset. We're sacrificing our asset, the inventory, to make the sale. And when we sacrifice the asset, it becomes an expense. In this case, cost of goods sold expense. So it's debit, cost of goods sold, 1,500 times 10, which would be 15,000. And then merchandise inventory, credit, 15,000. So there's two entries, one to record the sale and the other one to record the inventory going out and recognizing the cost of goods sold. Again, can you see what kind of gross profit we made on this? Well, we had sales of 21,000. We have cost of goods sold of 15,000. That would be a gross profit of 6,000. Just saying, there's nothing that you have to know, in this problem. I just thought that's an interesting observation. Okay, now, if Allied wants to pay us within a discount period, when is the discount period? Well, the terms were 210 net 60. So they have to pay us within 10 days. So what's 10 days from the 5th? 5 plus 10 is 15. Okay. So that means we have to, Allied has to pay us by May 15 to get the discount. I even say that down here. To take the 2% discount from May 5th sale, the customer must pay by the 15th. And you know what? I'm wondering, is it going to be the 5th? Oh, yeah. Spoiler alert. They are going to pay on the 15th. So we are going to take that discount on May 15th. Just saying, keep that May 15th in the back of your mind here. Okay, let's go on to the next one. On the 7th, Macy returns 125 units because they did not fit customer needs. Okay, well, how much did they return? 125 units. Well, they would tell you, oh gosh, the invoice amount is $1,750. Wow, which cost $1,250. Oh, they already do it for you. It's already there. Okay, we don't even have to figure it out. Well, I was going to do it. That's where they get that $1,750. They're returning 125 units, and remember, we sold it to them for 14. So they're returning $1,750 of the merchandise. Well, if they return it, we didn't make the sale, right? So we're going to reduce our sales, but we're going to do it through the contra account, sales, returns, allowances. And well, if they returned it, they don't owe it anymore, right? Now, because it's the customer is giving us back the inventory, we've got to record the inventory coming back in. And so that 125 units is being received by us, and it cost us $10, right? So it's $1,250. Now, because we're receiving it, the inventory, it wasn't sold. So we have to reduce our cost of goods sold by $1,250. Okay. Let's keep on going. May 8th, Macy discovers that 200 units are scuffed, but are still of use, and therefore keeps the units. This is an allowance. Well, an allowance, we only need one journal entry, right? Because we'll just record the sales, returns, allowances, but they're keeping the inventory, so we don't have to do that second one like we just did. We don't have to do this one when we do the 8th. Let's go ahead and go for it. Discovers 200 units were scuffed. Oh, and oh, wow, it tells you what it is. We're going to reduce it by $300, right? So we're given an allowance of $300, and of course we reduce the receivable because he doesn't owe it anymore, because we're giving him a little bit off the price, and we didn't make the sale, so we're going to debit our contra sales, returns, allowances. And that's it on this one, because in allowance they don't give us the inventory, so we don't have to do that second entry. All right. Now, this one is probably the hardest one in the whole, probably the whole chapter. Allied received payment from Macy for the amount owed on the May 5th purchase. Payment is net of the returns, the allowances, and any discounts. Oh boy, now we're in it, right? Well, I'm going to go ahead and just put it down and explain myself here. So, well, how much does he owe us? Well, check this out. Originally, he owed us $2,100. See that? That's where we get the $2,100 right here. But then he returns some merchandise. He returned $1,750, right here. So that goes here, and then on the 8th, we gave him an allowance, which reduced the receivable by $300. So he really only owes us at this point $18,950. Now, does he have to pay us that full $18,950? No, because he's paying within the discount period. You know, remember that magic date, May 15. To take the 2% discount from the May 5th sale, the customer must pay by May 15th. The customer is So how much is the discount? Well, it's 2% of what he owes. So he's going to take 2% off, right? And remember, if we give him a discount, we didn't make the sale. That's why we're debiting sales discounts, right? We could debit sales directly because we didn't make the sale, but we want to keep that account separate. So we do so through the contra sales account. So anyway, that's going to be 379. 18,950 times 2% is 379. Now, to get the amount of cash, all we need to do is plug and chug, right? 18,950 minus the discount, and that's going to be 18,571. Now, you know me, I like to check my work. So I plugged and chugged it here, 18,571 by going 18,950 minus 379. I plugged the amount so that debits equal credits, and it's 18,571. Now I can test that number by this. I know that we're giving him a 2% discount, right? That means that he's going to have to pay us 98% of it. So if you go 18,950 times 98%, you're going to get 18,571, and it agrees. So you calculated this number two different ways. It's got to be right. All right. Okay. This will be the last thing we do. We're going to complete quick study 410 on page 182. 410 on page 182. So I'm going to end the show, and I'm going to go down here to there it is. Okay. So let's go ahead and read all about it here. Page 182, 410. We're going to prepare these sales transactions using the perpetual inventory system and the gross method. Well, that's all I'm going to have you do is the perpetual inventory system and the gross method. On April 1, sold merchandise for $30,000 with credit terms net 30. That's kind of cool. There's no early payment discount. Makes it easier for us. The invoice is dated April 1. The cost of the merchandise is $1,800. Okay. So on April 1, we make a sale of $3,000, and the guy owes us now, right? Accounts receivable. So debit accounts receivable, $3,000, credit sales, $3,000. Now, to make that sale, we had to give them our inventory. We had to sacrifice that inventory. So, and how much did that inventory cost us that we sacrificed? $1,800. So we're going to credit the asset merchandise inventory, and when we use up that inventory and it's sacrificed, we record the cost of goods sold expense of $1,800. So debit, cost of goods sold, $1,800. Credit, merchandise inventory, $1,800. Okay. Yeah, let's go ahead and do the next one. On the 4th, the customer in the April 1 sale, the April 1 sale returned $300 of merchandise for full credit. Okay, returned it. So there's going to be 2 journal entries, right? One to record that we didn't make the sale, and the other one is we received the inventory. The merchandise, which had a cost of 180, is returned to inventory. So anyway, here we go. He's returning $300 of merchandise. So we didn't make the sale. So debit sales, returns, and allowances for $300. And since he returned it, didn't make the sale, he doesn't owe it anymore, $300. And then he gives us back the inventory. And that inventory cost us 180. So we're going to put 180 back into inventory. And because we didn't sell it, we have to back out that cost of goods sold. So debit, merchandise inventory, 180, and credit, cost of goods sold, 180. Okay, the next one on the 8th, we sold merchandise for 1,000 with credit terms 110, net 30. The invoice dated April 8th, cost of the merchandise is 700. Okay, so we sold it to them, made a sale of 1,000, and now he owes us the money. So debit, accounts receivable of 1,000, credit sales of 1,000. But to make that sale, we had to give them our inventory, and that inventory cost us $700. So we have to reduce our inventory by 700. And when we sacrifice that asset inventory, it becomes expense, cost of goods sold expense. So debit, cost of goods sold, 700, credit, merchandise inventory, 700. Okay. Now, on the 11th, we received payment for the amount due from the April 1 sale, less the return on April 4. Well, how much does he owe us? Well, I have a little T account. You might want to do this too. I can keep track of it. So on April 1, we sold him $3,000, right, worth of merchandise. So he owes us 3,000, right? He owes us 3,000. But then on the 4th, he gave some the inventory back. We didn't make the sale, and he doesn't owe it anymore. So there's our credit to 300. So this is how we do it. He originally owed us 3,000, but then on the 4th, he returned $300 worth. So he only owes us 2,700. I like this because you get to keep track of the balance. Sometimes in these problems, they don't tell you what the balance is. You've got to figure it out. A T account is a really good way of doing that. Now, because this inventory was sold with no possible sales discounts, they're going to have to pay the full amount. So on April 11th, debit cash, 2,700, credit accounts receivable, 2,700. Okay. Okay. Well, that's part 2. I've got one more part to do. And so you guys can be looking for that. Until now, happy studying. Bye-bye.